Look, I need you to see something that's happening right now in the precious metals market. Something that doesn't happen often. Something that, when it does happen, changes everything for the people who pay attention and absolutely devastates those who don't. Gold just broke through a critical resistance level that it's been testing for months. We're talking about a technical pattern that spans from December 2024 into January 2025, a massive triangle formation between $2,500 and $2,700 that just resolved to the upside. And when I say just, I mean within the last few trading sessions. The breakout is confirmed. The volume is there. The momentum is building. But here's what most people don't understand about breakouts like this. They're not random. They don't happen in a vacuum. This particular breakout is the culmination of forces that have been building for years, and it's signaling something much bigger than just a short-term price move. Let me take you back to understand what's really happening here. In early 2024, gold was trading around $2,000 per ounce. Respectable, but not extraordinary. Silver was hovering around $23. The mainstream financial media was focused on stocks, on the AI boom, on everything except precious metals. And that's exactly when the smart money started positioning. Central banks around the world began accumulating gold at a pace we haven't seen since the 1970s. The People's Bank of China added over 225 tons to their reserves in 2024. Turkey bought 148 tons. India, Poland, Singapore, the Czech Republic, all significant buyers. This wasn't speculation. This was strategic repositioning by the institutions that understand what's coming. And what they understood was this. The global monetary system is undergoing a fundamental transformation. The dollar's role as the world's reserve currency is being challenged in ways that would have been unthinkable a decade ago. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems. Saudi Arabia is now accepting yuan for oil sales. The United Arab Emirates is settling trade in rupees and dirhams. This isn't conspiracy theory. This is documented policy, and it's accelerating. Now, while this geopolitical chess game was playing out, something else was happening in the physical gold market. The premium for physical gold over paper gold started widening. In London, the heart of the global gold market, dealers were reporting delivery delays. In Asia, premiums for gold bars were hitting multi-year highs. The Shanghai Gold Exchange was consistently trading at a premium to London and New York. What does that tell you? It tells you that there's more demand for actual physical gold than there is supply. And when you have that dynamic in any market, price has only one direction to go. But let's talk about the technical picture, because this is where it gets really interesting. Gold spent most of late 2024 consolidating in that $2,500 to $2,700 range I mentioned. Technical analysts call this a symmetrical triangle, and it's one of the most reliable continuation patterns in technical analysis. What it means is that buyers and sellers were in equilibrium, testing each other, building up energy, and the longer that pattern persists, the more explosive the eventual breakout tends to be. We saw this exact pattern in 2019, right before gold went from $1,400 to $2,000 in less than a year. We saw it in 2010, before the run to $1,900, and we're seeing it again now. The breakout happened with conviction. We're not talking about a tentative move above resistance that immediately gets sold back down. We're talking about a decisive break, confirmed by volume, confirmed by follow-through. Gold is now trading above $2,700, and more importantly, it's holding those gains. Silver, meanwhile, is doing something even more dramatic. For the year 2024, silver is up approximately $10 per ounce. That's a 50% gain. And if you understand the gold-to-silver ratio, you know what that means. The ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. It's moved from around 90:1 down to the low 80s. And historically, when that ratio compresses, it's a sign that silver is about to outperform gold significantly. Why? Because silver is both a monetary metal and an industrial metal. And right now, industrial demand for silver is exploding. Solar panels, electric vehicles, 5G infrastructure, medical applications, silver is essential to all of it. The Silver Institute estimates that industrial demand for silver will exceed 700 million ounces in 2025. Meanwhile, global mine production is around 830 million ounces. The margin is razor thin. And here's the kicker. Above-ground silver inventories are at multi-decade lows. The COMEX warehouses, where silver futures contracts are settled, have seen their registered silver, the silver actually available for delivery, drop by over 40% in the past 2 years. We're talking about less than 50 million ounces of registered silver backing a paper market that trades billions of ounces in notional value. Do you see the problem? This is a powder keg, and the fuse is lit. Now, let me tell you a story that illustrates what happens when these dynamics play out. In 1979, gold was trading around $250 per ounce. Inflation was raging. The dollar was losing purchasing power. Trust in the government was at an all-time low after Watergate and the Vietnam War. And then, in January 1980, gold hit $850 per ounce. That's a 240% gain in less than a year. But here's what most people forget. The real move didn't start in 1979. It started in 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold. That was the moment the rules changed. That was the moment gold went from being a fixed price of $35 per ounce to a free-floating asset. And over the next 9 years, gold went up 24 times. We're in a similar moment right now. The rules are changing. The monetary system that's been in place since Bretton Woods is breaking down. And gold is responding the way it always does when the foundation of the financial system is in question. But let's get specific about what's driving this current breakout, because understanding the mechanics is crucial. First, there's the Federal Reserve. After raising interest rates aggressively in 2022 and 2023 to combat inflation, the Fed has now pivoted. They've started cutting rates. And while they're trying to do it gradually, the market knows what's coming. Lower interest rates mean lower opportunity cost for holding gold. When you can get 5% in a money market fund, gold looks less attractive. But when rates are at 3% or 2% or lower, and inflation is still running at 3% or 4%, suddenly gold's zero yield doesn't look so bad. In fact, it looks like the only way to preserve purchasing power. Second, there's the fiscal situation. The U.S. national debt just crossed $36 trillion. The deficit for fiscal year 2024 was over $1.8 trillion. Interest payments on the debt are now the largest line item in the federal budget, exceeding defense spending. This is unsustainable, and everyone knows it. The only way out is to inflate the debt away, which means printing more money, which means the dollar loses value, which means gold goes up. Third, there's the geopolitical risk premium. We have wars in Ukraine and the Middle East. We have tensions between the U.S. and China over Taiwan. We have instability in the banking system, with regional banks failing and being absorbed by larger institutions. Every one of these events drives demand for safe haven assets, and gold is the ultimate safe haven. Fourth, and this is critical, there's the ETF flow dynamic. Gold ETFs saw massive inflows in late 2024. The SPDR Gold Shares ETF, the largest gold ETF in the world, added over 100 tons of gold in the fourth quarter alone. When ETFs buy gold, they have to buy physical gold to back the shares. That creates real demand in the physical market, which supports the price. And fifth, there's the technical momentum. Once a breakout is confirmed, it tends to attract momentum traders, algorithmic trading systems, and trend-following funds. These players don't care about fundamentals. They care about price action. And when price is breaking out, they buy. That creates a self-reinforcing cycle that can drive prices much higher than fundamentals alone would suggest. Now, I want to pause here for a second because if you're sitting on $100,000 or more in retirement accounts, there's something you should know. I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties, how to choose a custodian, what the fees look like, all of that. If you're thinking about protecting your retirement savings with gold, it's worth checking out. All right, back to the breakout. Let's talk about what happens next, because this is where it gets really interesting. When gold breaks out of a multi-month consolidation pattern like this, the initial target is typically the height of the pattern added to the breakout point. In this case, the triangle was about $200 wide. from $2,500 to $2,700. So the initial target would be $2,900. But that's just the first target. If momentum continues, if the fundamental drivers remain in place, we could see gold test $3,000, then $3,200, then higher. And here's why I think we're going much higher. We haven't even seen retail participation yet. Right now, this move is being driven by institutions, by central banks, by sophisticated investors. The average person on the street isn't buying gold. They're not even thinking about gold. They're worried about their 401k, about their mortgage, about inflation at the grocery store. But they're not connecting those concerns to gold. That will change. It always does. When gold breaks $3,000, when it's on the front page of every financial website, when your neighbor starts asking you about gold, that's when retail comes in, and that's when the real parabolic move happens. We saw this in 2011. Gold went from $1,400 in early 2010 to $1,900 by September 2011. The last $500 of that move happened in just a few months, driven by retail panic buying. People were lining up at coin shops. Premiums on physical gold were 10%, 15%, 20% above spot price. You couldn't get delivery for weeks. And then, of course, the bubble popped. Gold crashed back down to $1,200 over the next few years. A lot of people who bought at the top got crushed. But here's the difference between then and now. The fundamental situation is much worse today. In 2011, the national debt was $14 trillion. Today, it's $36 trillion. In 2011, the Fed's balance sheet was $2.8 trillion. Today, it's over $7 trillion. In 2011, we had just come through the financial crisis, but the system was stabilizing. Today, we're facing multiple crises simultaneously: geopolitical, fiscal, monetary, social. The case for gold is stronger now than it's ever been. And the breakout we're seeing is just the beginning. Let me give you another historical parallel that I think is instructive. In 1999, gold hit a low of $250 per ounce. It had been in a bear market for 20 years. Nobody wanted it. Central banks were selling it. The Bank of England famously sold half of its gold reserves at the bottom, a decision that's now known as Brown's bottom, after Gordon Brown, the chancellor who made the call. But then something changed. The dot-com bubble burst. 9/11 happened. The Fed started cutting rates. The dollar started weakening. And gold began a bull market that would last for 12 years, taking it from $250 to $1,900. That's a 650% gain. We're in the early stages of a similar bull market now. Gold bottomed in 2015 at $1,050. It's now at $2,700. That's a 157% gain. But if this bull market follows the same trajectory as the 2001-2011 bull market, we're not even halfway there yet. And silver? Silver went from $4 in 2001 to $48 in 2011. That's a 100% gain. If silver does anything close to that from its 2020 low of $12, we're talking about triple-digit silver prices. Now, I'm not saying that's guaranteed. Markets don't move in straight lines. There will be corrections, pullbacks, periods of consolidation. But the trend is clear, and the breakout we're seeing right now is confirmation that the trend is accelerating. Let's talk about the supply side for a moment, because this is often overlooked. Gold mine production has been essentially flat for the past decade. We're producing about 3,500 tons of gold per year globally. That's it. And the easy gold has already been mined. The ore grades are declining, the costs are rising. The lead time to bring a new mine into production is 10-15 years. Meanwhile, demand is increasing. Central banks are buying 1,000 plus tons per year. ETFs are accumulating. Jewelry demand in Asia remains strong. And now, with the breakout, investment demand is starting to pick up. You can't increase supply quickly in the gold market. It's not like oil, where you can drill more wells. It's not like copper, where you can ramp up production at existing mines. Gold is scarce, and it's getting scarcer. Silver has the same dynamic, but even more extreme. Silver mine production is around 830 million ounces per year, and about 70% of that comes as a byproduct of mining other metals like copper, lead, and zinc. So if those base metal mines slow down, silver production slows down. And right now, with copper prices under pressure and lead and zinc in surplus, there's no incentive to increase production. but demand for silver is exploding. Solar panel installations are growing at 20% per year. Each panel uses about 20 grams of silver. Electric vehicles use 25-50 grams of silver per vehicle. 5G infrastructure requires silver for its conductivity. Medical applications, from wound dressings to antimicrobial coatings, are growing rapidly. The Silver Institute projects that industrial demand alone will consume 85% of total silver supply by 2025. That leaves just 15% for investment in jewelry. And if investment demand picks up the way it did in 2010, 2011, we're going to see shortages. Real physical shortages. And when you have shortages in a market, price is the only mechanism to balance supply and demand. Price has to go up until demand is destroyed, or new supply comes online. And in the case of silver, new supply can't come online quickly. This is why the breakout in gold is so significant. It's not just about gold, it's about the entire precious metals complex. It's about a fundamental shift in how investors view risk, how they view the dollar, how they view the stability of the financial system. Let me tell you about what's happening in the derivatives market, because this is where things get really interesting. The COMEX, the commodities exchange where gold and silver futures are traded, has a problem. The open interest in gold futures, the number of contracts outstanding, is enormous. Each contract represents 100 ounces of gold. And while most of these contracts are settled in cash, not physical delivery, there's always the risk that someone will stand for delivery. In a normal market, that's not a problem. The exchange has enough gold in its warehouses to cover deliveries. But we're not in a normal market. The amount of registered gold, the gold that's actually available for delivery, has been declining. It's now less than 10 million ounces. Meanwhile, open interest is over 400,000 contracts, representing 40 million ounces. Do you see the problem? If even 25% of contract holders demanded physical delivery, the exchange wouldn't have enough gold. They'd have to declare force majeure, settle in cash at whatever price they decide, or scramble to find gold on the open market, which would drive prices through the roof. This is what's known as a short squeeze. And there are whispers in the market that it's coming. Not today, not tomorrow, but at some point in this bull market, the paper gold market is going to break. And when it does, the price of physical gold is going to decouple from the paper price. We could see premiums of 20%, 30%, 50% for physical gold over the spot price. We've already seen glimpses of this. During the COVID panic in March 2020, you couldn't buy physical gold at spot price. Dealers were charging $100, $150, $200 over spot for coins and bars. And that was just a temporary disruption. Imagine what happens in a sustained shortage. The same dynamic exists in silver, but it's even more pronounced. The COMEX silver warehouses have less than 50 million ounces of registered silver. Open interest is over 150,000 contracts, representing 750 million ounces. The ratio of paper silver to physical silver is 15.1. That's insane. And here's the thing. It only takes one large player to break the market. One sovereign wealth fund, one billionaire, one institution that decides they want physical silver and they're willing to stand for delivery. That's all it takes. This is why the charts are so important right now. The breakout we're seeing is technical confirmation of what the fundamentals have been telling us for months. The precious metals market is setting up for a major move, and the people who position themselves now, before the crowd realizes what's happening, are going to do extraordinarily well. Let me give you a framework for thinking about this. Gold is not an investment. It's insurance. It's a hedge against the debasement of fiat currency. It's a store of value that's been recognized for 5,000 years. When you buy gold, you're not betting that gold is going to go up. You're betting that the dollar is going to go down. And given the fiscal and monetary policies we're seeing, that's not a bet. It's a certainty. The only question is timing. And the breakout we're seeing right now is telling us that the timing is now. Silver is different. Silver is both insurance and speculation. It has the monetary properties of gold, but it also has industrial demand. And because the silver market is so much smaller than the gold market, about 1/10 the size in dollar terms, it's much more volatile. When silver moves, it moves fast and it moves big. If you're conservative, you focus on gold. If you're aggressive, you add silver. But either way, you need exposure to precious metals in your portfolio. not 1% or 2%. I'm talking about 10%, 15%, maybe more, depending on your risk tolerance and your view of where the world is headed. And here's the thing. You don't have to get the timing perfect. You don't have to buy at the absolute bottom. The trend is your friend. As long as you're buying during the uptrend, as long as you're accumulating before the parabolic phase, you're going to do well. The breakout we're seeing right now is your signal. This is the market telling you that the trend has resumed, that the consolidation is over, that the next leg up is beginning. Now let's talk about what could go wrong, because it's important to understand the risks. The biggest risk to gold is a genuine, sustained economic recovery with low inflation. If the economy starts growing at 4% or 5%, if inflation drops back to 2%, if the Fed can normalize interest rates without breaking anything, then gold could struggle. The opportunity cost of holding gold would increase, and investors would rotate back into stocks and bonds. But do you see that happening? I don't. The economy is being held together by massive fiscal deficits and artificially low interest rates. The moment the Fed tries to normalize, something breaks. We saw it in 2018 when they tried to raise rates and unwind the balance sheet. The stock market crashed, and they had to reverse course. We saw it again in 2022-2023 when they raised rates aggressively and we got a banking crisis. The system is too fragile. There's too much debt. There's too much leverage. The Fed is trapped. They can't raise rates without causing a crisis, and they can't keep rates low without fueling inflation. It's a no-win situation. And in that environment, gold thrives. The other risk is a deflationary collapse. If we get a 2008-style credit crisis, if asset prices crash, if there's a scramble for dollars, gold could sell off initially. We saw this in 2008. Gold dropped from $1,000 to $700 in a matter of months as investors liquidated everything to raise cash. But here's what happened next. The Fed responded with massive stimulus. They cut rates to zero, they launched QE, and gold went from $700 to $1,900 over the next 3 years. So even in a deflationary scenario, gold is a good hedge. You might have a temporary drawdown, but the policy response to deflation is always inflationary. And that's bullish for gold. The final risk is government confiscation. In 1933, FDR signed Executive Order 6102, which required Americans to turn in their gold to the government at $20.67 per ounce. The government then revalued gold to $35 per ounce, effectively confiscating 40% of people's wealth. Could that happen again? It's possible. But it's unlikely. The political and economic context is completely different. Gold is no longer the basis of the monetary system. The government doesn't need to confiscate gold to devalue the currency. They can just print more dollars, and the backlash from confiscation would be enormous. That said, it's something to be aware of. And it's one reason why some people prefer to hold gold outside the U.S., in jurisdictions like Switzerland or Singapore, where property rights are more secure. But let's get back to the opportunity, because that's what this is really about. The breakout we're seeing in gold and silver is a once-in-a-decade opportunity, maybe once in a generation. The last time we had a setup like this was 2001, at the beginning of the last great precious metals bull market. And the people who recognized it and acted on it made life-changing returns. I'm not saying you're going to get rich overnight. I'm not saying you should bet the farm on gold and silver. But I am saying that if you don't have meaningful exposure to precious metals right now, you're taking a huge risk. You're betting that the current monetary system is sustainable, that the dollar will maintain its value, that governments will get their fiscal houses in order, and I don't think those are good bets. The charts are confirming what the fundamentals have been telling us. The breakout is real, the trend is accelerating, and the opportunity is now. So what do? First, educate yourself. Understand the difference between physical gold and paper gold. Understand the different ways to get exposure: coins, bars, ETFs, mining stocks, futures. Each has its pros and cons. Second, start small. Don't try to time the perfect entry. Dollar cost average. Buy a little bit every month. Build your position over time. Third, focus on physical. If you're buying gold and silver as insurance, you want the real thing, not a piece of paper that says you own gold, not a share in an ETF that might or might not have the gold it claims to have. The actual metal, in your possession, or in a secure vault that you control. Fourth, be patient. Bull markets don't move in straight lines. There will be corrections. There will be periods where it feels like nothing is happening. But if you understand the fundamentals, if you trust the trend, you can ride through the volatility. And fifth, don't wait. The breakout is happening now. The longer you wait, the higher the price you'll pay. And at some point, you won't be able to get physical metal at any price. This is your moment. The charts have confirmed it. The fundamentals support it. The opportunity is staring you in the face. The question is, are you going to act on it?